Welcome. It's episode number 36 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, and BTR. And today we're going to talk about something that affects all three of those categories. And it's a very timely topic, raising capital. You know, it's hard, right? And it's got even harder these past couple of months. I've had some conversations with folks of representing groups of different sizes, from big institutions to small local groups, being interact with different people at different industry conferences and other events these last couple of months. And I'll tell you, everyone, there's a range of feelings, but it's hard for everybody right now to raise capital. Even the biggest players, who are the biggest brand names, they'll tell you that they're doing 5 times more work to raise maybe half the amount of capital as they did before. They're knocking on more doors, trying to build more relationships, but it's hard. And investors of all sizes, GPs of all sizes, they've got LPs tied up in existing deals, and a lot of those LPs want to see some assets sold and capital recycled before re-upping onto the next deal. And that's tough to do when values aren't where you want them to be at this point. And by the way, they're not there. It's not because of demand fundamentals, but it's because of interest rates and the associated impact on values. A lot of domestic investors right now are more or less sidelined. They say they're in wait and see mode. And even if they say they're active, a lot of them they're really only going to consider some kind of hidden gem, sweetheart deal that rarely comes around. So for all intents and purposes, even the ones who say they're active, a good chunk of them are not. And then other LPs are just buttoning up and say they're only going to work with a few favored GPs, often more established players with longer track records. I've heard from investors who say foreign capital is more reluctant to invest in the U.S. right now because of tariffs and the tariff, disputes, or because of the potential impact of tariffs on their home countries. I talked about it a little bit in our tariff episode a few weeks back. I've heard even from multiple GPs who say that certain Canadian investment groups won't even attend their investor summits in the U.S., let alone invest in new deals. But at the same time, I'll tell you, I've also heard from GPs who said that while it's gotten harder to raise capital abroad, it's still doable. And some are actually faring better there than here in the U.S. And they'll tell you that for all the turmoil we see in our home country, all the negative headlines and the swings of elections and whatnot, some foreign investors still see the U.S. as far more stable and attractive than other parts of the world. And we saw that sentiment reflected in the AFIRE survey earlier this year, that survey covering international investors and their real estate appetite. I mentioned that a couple of weeks ago, one of these episodes. So they're there, and you just got to find the investors who have that mindset. Obviously, easier said than done, but some institutional GPs are obviously finding them. But again, whether you're raising capital in New London, Connecticut, or Old London, England, or Rome, Georgia, or Rome, Italy, or Tokyo, North Dakota, or Tokyo, Japan, it's a tough environment to be in the capital raising business these days. And by the way, yes, there is a Tokyo, North Dakota. It is spelled a little bit differently, Tokio, although I don't know how many accredited investors live there among the 2,000 or so folks in the population. All right, so here's what we're going to do today. We're going to try to be a little helpful on the topic of raising capital for real estate. I don't want to say a lot helpful because that'd be misleading. I don't think anybody could be a lot helpful on the topic of raising capital for real estate these days, but I'm going to try to be a little helpful. I'm going to set the goalpost pretty low, but I'm going to be a little helpful, I hope. We're going to talk about the state of fundraising, so you can be assured that you're not alone in those challenges. If for some reason you doubted that, or at least maybe your boss did, you can show them that it's an industry-wide challenge. And then I'll share some tips and strategies courtesy of some excellent papers written by some institutional players recently, and provide some other talking points as well. And then for today's conversation, I'm going to bring in Alicia Miller, the head of U.S. capital markets for Black Salmon, which is a real estate investment manager active across much of the South, based in Florida, raising capital domestically as well as abroad, especially Latin America. And I thought that Alicia was a good fit for this conversation because she represents a mid-sized firm with a track record, but not one of the mega institutional global brands that some investors may look and say, well, they're the exception, right? And so obviously, they can provide some great intel on this too for those who are willing to share it. But I thought it'd be good to bring in someone like Alicia, who maybe can relate well to a broad range of the industry. All right, before we jump in, I want to give a big thanks to our sponsors. First to JPI, leading apartment developer with a stated purpose to transform building enhance communities, and improve lives. And to Waymaker, multifamily investment group focused on Class A market rate apartments and attainable housing, partnering with best-in-class apartment builders across Texas and the Southeast. All right, so as always, we kick it off with Here's a Chart. And today we got some headlines to look at in the Here's a Chart section. And the first one I want to share with you is comes from Preqin's Q1 2025 quarterly update on real estate. And I want to read you a quick snippet from the Globe Street article on this report. It said, private real estate funds raised a total of $30 billion across 143 vehicles for the quarter. Again, this is first quarter. This compares to $15 billion fetched in Q4 of 2024 across 214 vehicles, $23 billion in Q3, $43 billion in Q2, and $36 billion in Q1. And then there were some big reported wins in Q1. I mentioned in the news section a couple weeks ago, Wall Street Journal's report about Brookfield raising $5.9 billion in Q1, targeting distressed real estate. And that article, inside the article, there was some speculation that, hey, maybe commercial real estate fundraising is back on the rise, green lights again. But that was Q1. Then Liberation Day happens, noise around tariffs, Moody's and others raise their odds of potential recession, et cetera. Now, of course, those headlines change daily. And I mentioned earlier that, the 90-day agreement with China was obviously a positive and markets rallied around that. But now there's more headlines about the European Union and potential, tariff disputes between the U.S. and the EU. And the bottom line is, nobody really knows how this is going to play out. And as I've said before, like people who talk about with great certainty about where this is going, either side of this, they don't know. But we do know this: investors do not like uncertainty. And we do have a lot of uncertainty right now in the macro environment. Obviously, we're still in the middle of Q2. We don't have a lot of data yet on fundraising. It's going to take a few months to get that, but we do have anecdotes. I shared some snippets from Blackstone's earnings call a while back on this podcast, and related to the impact of tariffs on fundraising and investor sentiment. And I want to rehash two of those quotes real quick here that impact fundraising and really just reflect that fundraising is hard for everyone right now, even the biggest name in the business. Steve Schwartzman from Blackstone, he said, uncertainty around tariffs and their potential impact on economic growth and inflation has dramatically impacted investor sentiment. And then John Gray said this. He said, my gut is this period of time may slow some of the movement towards real estate. Of course, talking about the movement of capital towards real estate, meaning translation, it's harder to get LPs to write checks toward real estate. He also had this to a little bit of a glass half full view at the end here. He says, but as the recovery begins to take hold, I think you'll see capital flow back. We've seen this historically in the 90s and after the financial crisis. I don't expect this to be any different. This may just create a little bit of a speed bump here. So again, some optimism from John Gray, even while acknowledging the short-term challenges. Here's another one. I want to share some color on the fundraising market I read in the Commercial Observer. This is a Q&A with John Ferguson. If you don't know his name, he is the co-chair of the global real estate group for the law firm Goodwin Procter. And that's a law firm that advises investment managers around who are raising capital, private capital. Their clients include names like Brookfield, the Carlyle Group, and a bunch of others. Let me read a comment that John made about the state of real estate fundraising. I'm going to read this quote. From our vantage point, during the second half of 2024 and the first quarter of 2025, we had been experiencing an uptick in transactions and capital raising alongside our clients. And then talking about Q2, he says, anecdotally, we are seeing and hearing that some non-U.S. investors have become apprehensive about underwriting opportunities, which in commercial real estate tend to be longer dated commitments, often in the 5 to 10 year range. And that has introduced potential additional risk that could result in a chilling effect on the flow of non-U.S. capital into the U.S. and or raise the cost of capital by increasing return expectations in underwriting. So good color from John Ferguson there. All right, so enough of me telling you what you already know. Fundraising is hard right now. The real question is, how do you work through it? Well, here's some potential good news for optimists and opportunists. Invesco put out a paper last month noting that uncertainty can create opportunity. Invesco noted, quote, historically, periods of lower liquidity have presented attractive investment windows. We know from experience that attractive entry points emerge during periods of disruption and volatility, when there is less competition. As investors digest tariff implications, we'll be looking for those opportunities. And I wonder how many investors think just like that they want to be active when others are not. And I assume that probably a lot do. I think almost all of them probably want to be active if they can be, but then it becomes about execution. Who has capital and conviction to execute and who does not? So how do you position your shop to remain active in this environment? How do you make the case for multifamily, SFR, and other real estate? Well, first, a couple of caveats. I'm not a fundraiser myself. I'm not a financial planner. I am not a CFA. I'm not here to give you investment advice. So consult with your financial advisor for advice. But I do want to talk to the folks out there raising capital and share some strategies that are being used by some of the bigger shops out there right now. A bunch of them openly share their investment theses and pitch decks online, so you can see some of their arguments for real estate right now amidst a tariff, amidst environment that's become more uncertain due to tariffs. So I'm going to share a few briefly here, and there's a bunch, but I'm just going to highlight a couple that stood out to me. Cohen & Steers, an investment manager, they made the case for real estate in a report they put out last month about the impact of tariffs. And they laid out 5 arguments for real estate and other real assets that fundraisers of all sizes and types could likely borrow from. So let me read through kind of a truncated list of these 5. Number 1, real assets, including real estate, tend to generate predictable revenues and high dividend yields due to longer-term leases or contracts. Number 2, most real assets have lower direct exposure to tariffs than many other asset classes, and that's true certainly of SFR and apartments and BTR. Real assets like real estate are benefiting from strong secular themes that we believe can keep their momentum almost regardless of tariff pressures. Number 4, the starting point for valuations for real assets is relatively attractive, and certainly we've seen that in the apartment market, where values have been impacted by the higher rates we've seen for the last couple of years. Number 5, real assets have also historically outperformed in inflationary environments, particularly when inflation surprises to the upside, which also should sound a little bit familiar, although that could swing both ways. I saw a good quote in an article recently attributed to Paul Buckley, who's the CEO of First Avenue, and he said he anticipates, quote, a migration of investor capital towards infrastructure and real estate asset classes as investors seek a combination of return and certainty. So the same idea is being shared by Cohen & Steers here. There's no certainties, of course, but relative to alternatives, real estate, the argument here is that real estate does have some potential advantages. Another one for you. This is from Nuveen, Donald Hall, who's the global head of research there. He put out a good paper last month with 4 quick points I want to share. And there's some overlap with the other themes, but again, these are topics I think apply to real estate GPs of all sizes. Number 1, uncertainty caused by tariffs could weigh on the economy and real estate, but the asset class enters this period in relatively strong position. Number 2, values substantially reset over the last 2 years, which helps de-risk the asset class going forward. In other words, it's not peak pricing. We've already had some correction in values driven by interest rates. Number 3, construction levels are the lowest levels in over a decade, which bodes well for fundamentals. And we're talking about real estate overall, and certainly for apartments. I've talked about this a lot. We've seen apartment starts falling to 12 and 13-year lows. Number 4, in a period of uncertainty, investors should focus on property sectors with resilient demand backed by megatrends and structural imbalances. And those last couple of points are key for multifamily and SFR groups raising capital. There's noise, right? I mean, there's no denying that. There's no smoothing over it, no downplaying it. There is noise. There's recession risk. A recession is no certainty, of course, but you can't just totally ignore the possibility. So you want to focus on the bigger picture. You want to elevate the discussion to, in Nuveen's words, megatrends and structural imbalances. And I think this is a point that holds, again, whether you're an institutional investor like Nuveen or a mid-sized investor like Black Salmon or a small one-market investment shop. So what are those megatrends and how does it apply to apartments and SFR? And there's a bunch, but I want to hit on a few here pretty quickly. Number 1, we have a structural shortage of housing. 4 to 7 million units, depending on who you ask. We've seen a temporary supply-demand imbalance of late due to the surge of apartments and BTR over a short period of time, but that's going to get leased up eventually. And in the meantime, starts have plummeted. So no one other than the conspiracy theorists really going to argue that we're oversupplied structurally. I mean, we're still undersupplied. Starts are way down below where they were even prior to the pandemic, and that trend started way before tariffs made headlines. So if anything, tariff fears could just prolong the supply drought and potentially accelerate a potential recovery. So bottom line, we have a shortage of housing, and this is a point that's easy to support, even just with some Googling. You don't need a research subscription for that. Number 2, demographics and delayed adulthood. People are waiting longer to buy homes for various reasons. That means they're renting longer. The elongating renting stage of life equates to higher net demand, even in a low growth market. Obviously, the massive gap today in the cost of renting versus buying contributes to this, but this trend also predates the rise in mortgage rates. Each generation obviously has been waiting longer to get married and have kids, et cetera, and those are traditional triggers for home buying. Third thing, and this is one that I don't think people talk about enough. America's biggest rental construction boom occurred in the 1970s. In total, about 10 million of America's 23 million apartment units were built in the 70s or earlier. These homes are obviously not getting any younger. And that means there's opportunities for value-add investments in some cases. And by the way, I hear people say, we finished all the value-add stuff in the last cycle and the big value-add boom, and that's crazy. There's obviously a lot of stuff that hasn't been touched in decades. Maybe some that in locations that shouldn't be, or at least not, it couldn't be done profitably. But there's still a lot of older apartments out there. And those are properties that are at risk of falling into obsolescence. Or in another case, it just means there's a severe shortage of quality, attractive investment grade rental housing for both SFR and multifamily for middle and upper income renters. And we see this especially in older cities in the Midwest and parts of the Northeast and the West Coast who just haven't built as much housing in recent decades. And in other cases, it just supports the need for new construction and for new development. Obviously, I tell people all the time, but obviously the next generation of renters, they're not necessarily going to want to live in the same units, in the same neighborhoods built for their great grandparents. A lot of them are going to follow the path of growth. And a lot of those growth cities don't have a lot of that older housing and naturally occurring affordable housing from, pre-1980. And they're growing largely because they are building new housing. And last thing I'll share is that, rental housing tends to have a lower floor. In the Great Financial Crisis, apartments bottomed out around 92% occupancy nationally. Rent cuts bottomed around 5 or 6%. Similar patterns for SFR. And obviously it varied by market, of course. But even a poor performing rental housing portfolio could be 90% occupied. So you compare that to other commercial real estate types, or 1 or 2 move-outs can crater revenues, or other asset types altogether outside of real estate. That's a lower floor that provides some protection, particularly if you have flexibility on your hold period and your exit, which obviously is an important caveat, especially in a higher rate environment and an uncertain environment too. And that's probably a good point to end on here, is that this is a tough market for market timers, obviously. We had a couple of years where you could buy something, put in some capital, some CapEx, and sell it a couple of years later, generate some good returns. It's much tougher to do that, obviously, right now. And a lot of the distress in the market today isn't related to occupancy or rent necessarily, but to interest rates and the cost of debt for GPs and maturing loans, or reduced values due to higher rates for assets you hope to sell by a certain point, return capital back to investors. So I think it's, again, stating the obvious here, but the flexibility of the hold period is certainly an important variable right now, especially given the macro uncertainty. All right, next up, rental housing trivia. All right. Today's rental housing trivia is going to be presented by Foxen, a technology-first renters insurance compliance and rent reporting platform that helps you reduce risk and drive NOI. So check them out at foxen.com. And thank you for sponsoring rental housing trivia. So today's trivia question is, where are the first known garden apartments in the U.S.? So where were they first built? Where did that term come from? And I'm looking for a city name in this. And for those of you who are at ULI, you're allowed to answer, but hopefully you remember, because we did share this on stage there at the Multifamily Product Council session. All right, next up in the news. All right. First one, Wall Street Journal. Austin's reign as a tech hub might be coming to an end. Regional tech hubs across the U.S. are losing talent as workers return to the coast, with Austin being one of the hardest hit. And this is marked as an exclusive. All right, so here we go again. Another article predicting the death of Austin. And, it kind of reminds me of all the pandemic era articles predicting that Manhattan was going to be gone forever. So one extreme or the other. It's just a different part of the country now. So the actual article states that a new report from venture capital firm Signal Fire shows that in 2024, big tech employment declined by 1.6% in Austin, and startup employment fell by 4.9%. All right. In other words, tech employment fell so little that it's likely within the margin of error. So here's the biggest challenge for Austin is, and I tell people this all the time, I think I probably mentioned this here before too, is that it's just a much smaller market than people outside Texas realize. It's a one highway city. And I know there's that outer belt now, but there's very little out there other than Elon Musk's facility. So Austin is still on the smaller end of the major markets in terms of size. Smaller equals more volatility. Volatility works both ways. When it's hot, it's hot. When it's not, it's not. That's true of tech employment. It's true of housing. It's true of the apartment market. Right now, Austin is certainly not blazing hot like it was in 21 and 22. Yes, it has cooled, but I actually looked up some stats here because I think people don't realize, as much as we pick on Austin, and for good reason, it is definitely the coldest apartment market right now in the U.S., but it's by pretty much any other MSA standards. When we look at just demand drivers, it's still a hot market. Austin still ranks in the nation's top 10 for population growth, still ranks in the nation's top 10 for job growth rate, still ranks in the nation's top 10 for apartment absorption. But Austin's housing supply, both for sale and for rent, was built up, and it was built up for a continued blazing hot demand environment that just wasn't sustained. And that's going to take time to correct, but it's already happening. Starts have plummeted. Eventually, demand's going to catch up to supply. Narrative will shift back to undersupply, and we'll be seeing headlines about tech jobs growing again too. Right now, it's tough. It's tough times to be in Austin real estate of any type. Longer term, I don't know exactly when, but longer term, Austin will be fine. Next headline, also from the Wall Street Journal: Trump teases the possibility of taking Fannie Mae and Freddie Mac public. Trump tweeted out, "I am giving very serious consideration to bring Fannie Mae and Freddie Mac public. Fannie Mae and Freddie Mac are doing very well, throwing off a lot of cash at a time and the time would seem to be right." So I've talked about this a lot. I'm not going to drone on about it here more, but I want to make a couple quick points. Number one, whatever happens here will be dictated and determined by single family, not multifamily. The administration and other policymakers are thinking about the impact to mortgage rates and the future of the 30-year mortgage. Multifamily is not a driving force; it's an afterthought. Okay, so all of us who love multifamily, we understand our place here, right? On the multifamily side, though, for what it's worth, I do think there's a strong case to be made that Fannie and Freddie could achieve their mandates of affordability, liquidity, and stability better if taken private. And here's why. Much of the affordability component is impacted by the other two mandates, stability and liquidity. Fannie and Freddie have become more politicized in recent years by both sides. So, I was talking to some folks from working for the agencies and just kind of, I don't want to put any words in anybody's mouth here, but I'm going to use my own words. But the way I'd kind of describe this is thinking about, imagine working in a place where you're riding a pendulum swing of priorities that can change every 4 years and overnight after an election. And they've become not only lenders, but people don't realize outside of the industry that they're also now regulatory agencies in of themselves, enacting operational restrictions on borrowers, which was an unheard of thought 5+ years ago. So if that slippery slope goes too far, you obviously risk the market becoming less stable and less liquid. Plus, I know David Brickman would say, David's the ex-CEO of Freddie and past guest of this podcast. He'd tell you that the agencies have become less innovative under conservatorship in terms of living up to their mandates as well. And he made some good comments on this in the podcast. I believe that was back in Q4 at some time. So we'll see what happens. It's complicated, but remember, conservatorship was never meant to be permanent. Next headline comes from NBC 10 in Boston. I'm going to read this to you a little bit. Headline is Professional Tenants Don't Pay Their Rent, but Taxpayers Do. It reads, over the past year, the NBC 10 Boston investigators have exposed professional tenants. Attorneys and police use that term for people who make a living by taking advantage of property owners. Thanks to tenant protections in Massachusetts, they use the law to get away with not paying rent for years. Despite the lengthy records in housing court, NBC 10 Boston found taxpayers are still paying rental assistance. So great work by NBC 10 in Boston. This topic does not get the attention it deserves from most media or policymakers. So I want to give kudos here for showing the effort and the intellectual curiosity to connect the dots and not just sort of, gloss over it like all too often happens. All right. Fourth headline comes from Bloomberg. It says, major New York City landlord puts thousands of units in bankruptcy. Says Joel Weiner, a major owner of New York City apartments, has put properties with thousands of rental units into bankruptcy months after a bank sought to foreclose on them. So, just quick comment on here. I don't know the portfolio or the properties or the owner, so I'm not going to comment on that. I just want to say this. New York City has a major housing supply shortage, but that does not mean, a housing shortage does not mean it's automatically profitable to own apartments there. The operating environment in a city does matter, especially when the rules of the game could get changed midstream, as occurred in New York multiple times. Most recently in 2019 with the changes in laws to the rent stabilization programs there, and more recently with the passage of the exceptionally misleadingly named good cause eviction legislation, aka Rent Control 5.0. All right, let's circle back to our rental housing trivia question. And this week's question was, where are the first garden apartments in the U.S.? Where are these first built? And the answer is New York and Jackson Heights neighborhood of Queens. The garden apartments built in 1917, originally called garden apartments, but actually changed to Greystone in 1925, because by then, less than a decade later, the term had become generic. But this now known Greystone property coined the term garden apartments. It was inspired by buildings in London and Berlin, and by the company that built it, the Queensborough Corporation. They built these garden apartments, the first in the U.S. on what was then farmland in Queens. The first phase cost a whopping $400,000, and it was designed for, that's for the complex, of course, not for an individual unit, and designed for middle-class families to give them alternatives to tenement slums or higher-rise buildings that lacked good ventilation or lighting. Also provided greenery that just didn't exist in most multifamily developments, but with this medium density approach. So there we go. That's the first of what became a massive trend in the U.S., and hopefully we still haven't seen enough of this across the rest of the world, but it's been a phenomenal part of the supply story, the housing supply story here in the U.S., and a great contributor to rental affordability everywhere across the country. All right, next up, I am thrilled to welcome in Alicia Miller, head of U.S. Capital Markets at Black Salmon, for this week's conversation. This segment is going to be sponsored by the Guarantors, who offer a suite of insurance solutions designed to increase access for renters and strengthen risk mitigation for multifamily owners, operators. And for those of you attending NAA Apartmentalize in June, as I will be there as well at NAA this year. Hope to see you there. If you are there, stop by and see the Guarantors at booth 639 at the Expo. All right, so I'll be talking with Alicia about the challenges that she and other capital raisers are having in this environment and getting her take on what strategies are resonating with investors right now. All right, now we enter the interview portion of today's podcast, and I am honored to welcome in Alicia Miller, the head of U.S. Capital Markets at Black Salmon. So thank you so much for being here.
Yeah, happy to be here, Jay. Excited.
So first of all, I know you have a passion for real estate, so tell us a little about your story and how you get into the business.
I have a really unique story. I originally went to college for musical theater because I thought I was going to sing and act
That's quite
the
different.
rest of my life. Yeah, that's pretty different. So after I went to school for 1 year, I realized I didn't like that school, so I transferred. Went to another liberal arts school, and started to realize maybe I don't like theater people as much. And so I went back to Texas, where I'm originally from, and went to community college to try and figure myself out. I ended up going to University of North Texas, and I chose a communication studies degree because I still had no idea at the age of 2021 what I wanted to do, right? As most young adults, I think, feel.
Sure. Yeah. We can all relate to that.
Yeah. So as I was in college, was working for, a bar, right, in Dallas, and I was a cocktail waitress. And I actually met my first boss, waiting on him, at the bar. And he actually tricked me. When you're at a bar or something and you're trying to get, better tips or whatever, you say, hey, so what do you do? Try to make conversation, right? And he told me he invested in light bulbs. And I said, oh my gosh, that's such a great investment. It's a common product. Everybody needs it. It's so awesome. You probably are killing it, right? And he was so impressed by my ability to make conversation over, obviously, his lie, that he gave me an internship. So he ran a large real estate investment firm here in Denver. And they, at the time, or still do, they invest in middle market, shopping centers in the heartland of America, right?
Okay.
So during college, I was really great at opening doors, getting through gatekeepers, that they created a position for me on their capital development team right out of college. So right away, I was being taken to family offices, wealth management advisors, and starting to understand, the capital markets world, so to speak. But then I also say it was somewhat serendipitous. So one, my communication studies degree, even though it's not finance, had a lot of really applicable subjects that I guess tie into what I do, right? Which is really building relationships. So it was performance, rhetoric, and then interpersonal relationships, right? So it really helped me kind of craft, I guess, in a sense, how to effectively sell, right? Essentially, I'm in a sales position at the end of the day, though I think it's much more than that. But then also I say it's serendipitous because my family actually has a really big real estate portfolio. One of the stories I love to tell is, I had a grandmother who was living in LA, married to my grandfather. They were making two incomes, in the 1960s. And back then, two incomes was a lot of money. So they needed to get some write-offs, right? So they had a crazy neighbor say, hey, why don't you buy a rental property? And so they bought one, then they bought two, then they bought three, by the time my grandmother died, she had over 200 units that she had been acquiring since the 1960s. My mom, who's a nurse, has done the same. And so I always saw how in life the extras came from real estate. Yes, it's not you getting rich tomorrow. It takes a long time, but I saw where an average everyday person could actually generate wealth, long-term wealth, through the power of real estate.
That's a great story. I love it. And, it reminds me, I tell people all the time, I think most of us who end up in, especially rental housing, sort of end there by accident. And, some people know my story where I got laid off from a job in 2008, got newly engaged, needed a job, took a crummy job as a research analyst. And, here I am 16 years later and loving what I do. So I get it. So tell us, I know you've had a few roles in the industry. Tell us what you're doing today, or tell us a little about your company today, Black Salmon.
Yeah, so Black Salmon, we're a $2 billion AUM real estate development and investment firm. We're headquartered out of Miami. Really, the basis of Black Salmon today is we like to focus on two sectors: residential housing and industrial. Really, how Black Salmon got started was creating a platform for foreign investment to come into the U.S. My founders are originally from South America, though they're U.S. citizens today. And that's really driven us to where we're at today. Now we're in a position, and why they brought me on board was to really accelerate their growth within the U.S. We're a U.S. company. We're looking for U.S. capital as well as our foreign capital, but to get to the next echelon. And today, within those developments, we're specifically developing in Florida, where we have amassed a lot of land that we acquired back in 2017. And those are going to be some residential developments. And then we're very bullish on the industrial segment across the Southeast.
Yeah. Yeah, that's great. And that's one of the things that intrigued me about, wanting to talk to you about this topic, because I was just at ULI recently, Urban Land Institute's spring meeting. And the sentiment across the industry right now is that unless you're just, the biggest global investment groups, it's hard to raise capital. And so you got domestic investors, you have international investors, and you're obviously an established brand, but you're not the Blackstones of the world. So you represent, I think, a bigger piece of the pie. So I'd love for you just to describe for us the mood that you're seeing among LPs, particularly how it's changed since Liberation Day with the tariffs, and also anything as it's maybe any more recent changes since the 90-day deal with China was announced.
Yeah, I mean, I talked to some of my capital raiser friends. I mean, we'll all agree that it's the most difficult capital raising environment that we've been through, right? Yeah. I've been at this for 12 years. Obviously, I have peers who have been at it a lot longer. And I think it's because there's a lot of hesitation with the market. Some of that is from what we already know. A lot of alternatives are locked up because interest rates continue to stay high. There's a lack of liquidity for a lot of investments. Secondaries has been killing the market because a lot of these investments need to exit if there's some sort of institutional fund.
Yeah.
And you just see some hesitation with investors because things aren't panning out necessarily as they were told. And again, that comes back to timeline, to, what they expected the market to be. And then you see hesitation from the tariffs, right? There's a lot of unknowns. What does this look like? How is this going to impact, real estate? And then lastly, I would say there's, in some senses, I feel like there's a lack of adjustment to change, right? Like I always say, value add multifamily housing did great, right? Especially after the great financial crisis. If you got in early, you killed it in multifamily value add, right? But it's a different environment today. So I feel like there's a lot of capital that still believes in the value add strategy. And I'm not saying it's not there, but they only want that. They only want the cash flow strategy. And honestly, those opportunities don't really exist today. The cap rates don't make sense.
Oh, and they want the returns that we saw in 21, 22, right?
Yeah, exactly. And it doesn't exist. So, some of them are sitting tight, hoping that there's going to be another like GFC opportunity to pick up really, value added real estate. But we're still not seeing it. And I actually think there's probably going to be some bailout opportunities for these larger institutions that we may not see it.
Yeah, I tend to agree, and I go to a fair number of investor conferences and summits where sometimes my job is simply to tell people, "Hey, look, the post-COVID period may have spoiled you a little bit. We need to kind of reset expectations for what is normal." So, are you seeing any difference? I love that description you shared, but are you seeing any differences between domestic and international LPs in terms of their appetite for U.S. multifamily right now?
I mean, I would say foreign investment always favors multifamily in the U.S. You see a lot of disruption going on with other economies where, if you are of the wealthier class, you do want your capital to come into U.S. real estate. I would say there's still an appetite. However, I'd also argue, depending on what country you're working with, a lot of those countries look up to the U.S. as an example. So if the U.S. is stalled, they stall, right? Not always. I mean, it really does depend on that country, but we also see that, right? Typically, other countries are somewhat 9 months behind the trends of the US. So I think it depends on who you're talking to. I would say from the family office side, I think they're being a little more hesitant versus institutions, whether it be domestic or international, they have a mandate to get a certain amount of capital out.
Yeah. Yeah, that's a good point. And it's kind of a follow-up question to that. For the investors you're talking to actually are willing to place capital right now, what are their return expectations and how have they changed from, say the crazy period a couple of years ago that we were just talking about? And maybe also too, how those return expectations differ by investor type or profile?
Yeah, I mean, I would say your investor profile, it really depends. And I think it comes down to are they a high net worth? Are they a family office? Are they an institution? Because it's going to come down to wealth preservation versus wealth growth, right? I know several family offices that only want wealth preservation. They've made their billions. They don't want it to go away. They're looking at the legacy. So they're really looking at, mid-teens type of IRR, but in some sort of stable asset class that they're not going to have any risks with, right? Versus you'll have a family office that's in wealth growth mode that might take a little bit more risk because they're trying to really build up that family office. So they're looking for 20 plus, I would say, in the IRR ranges. Again, I think it depends on the investor profile type. I would say a lot of investors are very committed to wanting cash flowing opportunities. It keeps coming up in conversation. I'm sorry, but I don't really see cash flowing opportunities, at least new ones in today's environment. If you're doing a value add strategy, it's not truly cash flow because you're obviously putting more money into the business and whatever you're paying that preferred return is not from the cash flow of the business, at least not for the first 3 years. Development, I see a lot of investors, they either favor it or they don't, but they need to be very comfortable with a developer and they need to be very comfortable with the environment, the area in which that development is taking place. So it really depends on the group that you're talking to. And then I would say from the institutional front, that depends too. Like institutions are set up so differently. Like I know one of the largest institutions and they have a mandate where they can only be, say, I don't remember what it is, say 25% invested in real estate alternatives, no matter if it's performing really well or not.
Yeah.
So they've had to sell off to secondaries their positions in performing asset classes as we've seen the market volatility, right? And so you're also dealing with the fact of where are they at within their constraint mechanisms. And then if you get in good with an institution, there could be a turnover of leadership in 4 years. And then all that hard work that you built, there's a new program in place because obviously it can become very political.
Yeah, no, those are all great points. And so I'm curious to ask you then, what you described is, I think probably these challenges and expectations, you mentioned like 20 plus return expectations or something. It's like, that's not, I mean, that's tough to find anywhere, let alone in, multifamily. It's not like they just go, find something else like light bulbs, like you mentioned earlier. So, how do you, I'm just curious, how do you respond when someone says, "Hey, this is what we're looking for"? Do you try to just kind of say, "Hey, look, let's be honest about kind of where the opportunities are today," and kind of reset some expectations, or is that just kind of end the conversation if they want something at those levels?
I try to. One unique thing that Black Salmon is doing is we have some short-term opportunities where investors can come into our entitlement phase. It's not cash flow, but it's a 20-month opportunity. That's going to have a distribution, right? So sometimes I can steer them towards that direction. I also say, hey, I wish you luck. Let me know when you find that cash flowing opportunity. I would love to learn more about it, right? I'd be very surprised for them to find it quickly. And also I would say, why don't you look at what we're doing, right? Within our space, could this be suited somewhere else? And then I would say there's some other advantages we can do. If you're doing a direct deal, we've gotten into 1031 tick strategies. So oftentimes you're seeing investors that are just looking for some type of deferred capital gain entry point. And so I've spearheaded conversations in that way, right? You're trying to find the fit, but I mean, you can't push too hard. If they're not interested, they're not interested.
Of course, that's true in everything. So let me ask you a question more broadly about just, kind of trying to make the case for multifamily right now. LPs of all types obviously have a lot of reasons to be sidelined. We've talked about some of these: economic uncertainty. We have a lot of investors who have capital locked in current investments and they want to recycle that out, but it's not accretive to sell those assets yet and recycle in the next deal. We obviously have soft rent growth, at least for the moment. Of course, there's a lot of bullishness about the upcoming cycle with supply dropping off. So when you're talking to investors about multifamily, like what, if anything, you found to be impactful in making the case for investing in apartments?
I would argue that location really matters for your multifamily. I think not necessarily a multifamily in the middle of nowhere. That's a good deal, is a great investment, right? If you can't fill it, it's not going to be profitable, right? But if you're in a great location that has strong density, strong economics, is near mass transportation, there's obviously population growth, not population decline in those cities. Those are good things to look for. And I think that's something compelling. Also think about like industries moving to those markets. We're obviously very bullish in the Miami market. But Miami has a lot of wealth happening. Citadel moved to Miami. Ken Griffin put, $800 million of working capital in Miami within 1 year. Yeah. Right. And that has industry trends with other industries coming to Miami along with their health district. So you just see this huge growth happening in just that market. You can see it with Dallas as well. I mean, so also quality of life. I think we're continuing to see that Sunbelt trend. People don't want to live in the colder states. Additionally, they want to live where there's some tax incentives, right? If they can have a better quality of life and also get a kickback on not paying as much out of their pocket, it's favorable.
Yeah, I like that point on location, because you could say, hey, look, I guess, just thinking out loud here, you can say, okay, I get your concerns, but, you do see pockets across the country, and you can make the case for various markets in a lot of different parts of the country, I guess, that, hey, there's growth happening here, supply is decreasing, there's still opportunity.
Yeah, absolutely. I think that's the number one key takeaway. Again, as long as your multifamily, your housing project is near some type of economic factors, like it could be in a small town. Like I know people who invest in Little Rock, but it's right by a medical district. It's going to be easily filled, right? So you don't want it in the middle of a field where there's nothing around, right? So to speak. You want to be where there's actually,
path of growth. Yeah,
exactly.
Yeah. All right. Let me ask you another kind of question for capital raisers out there. A lot of LPs may prefer to maybe invest through a placement agent versus working with someone like yourself, an in-house capital raiser. So when you talk just to give tips to those who are listening, like when you talk to LPs that traditionally haven't worked with someone like yourself, like how do you encourage them to maybe build a direct relationship?
Well, a couple of things. One, placement agents are there to do one job, right? They're there to place capital for a large institution. And there's really no relationship building with that investor. Once that capital is placed, you don't really hear from them again. They probably don't even know you that well. I have one story where, at a previous firm, we had worked with a placement agent, just by chance. He was on my email marketing, right? And he brought us a group that ended up investing a good amount. But when we showed up to the meeting, that group had no idea who he was, and he had no idea who they were. He just knew their name, right? So I think the value in working with a capital raiser, it's more directly aligned, right? So, I capital raise within my institution, but I also am fully convicted by what they're doing, right? I'm directly aligned. I'm on the investment committee. I care about our projects, and hopefully, there's power in the relationship I build with my investors that value that as well. I also don't disappear. I always tell people, capital, this isn't about cool, I got someone to invest, I made a sell. I'm not rewarded by that, right? I've always loved my job because it's truly value creation. I'm presenting an opportunity to somebody who's actually going to generate more wealth from it, right? So it's not necessarily me taking and I move on to the next. Additionally, I care about my investors so much. They call me on my cell phone. I'm always available. And I think that really sets me apart as a capital raiser, so to speak, because I go the extra mile of really wanting to know them, because I really do care. I love my job because everybody has such a cool story for how they've generated wealth, right? Nobody's the same. And I treat that down to the high net worth individual, to the wealth management advisor, to the institution. Everybody's unique. But I think that's a key takeaway, is you want somebody directly in line who's going to give back to you when you have questions.
And for my placement agent friends listening, we love you too, but I just wanted to give my guests today a chance to answer that, because I know it's a topic that y'all run into.
And let me add on that. I'm not here to diss placement agents by any means. There's definitely a position for them, especially when you get into larger institutional capital. There are placement agents where their firm has done a heavy due diligence questionnaire with the group and has really been, digging into their books, et cetera, who's bringing about institutional capital that I'm never going to have a chance at those relationships, right? So there's definitely a place for it. But I think if you're raising smaller capital chunks and you want that personal touch, there's, maybe go the in-house capital raiser, right?
Yep. No, totally fair. I guess it's a fun topic to get into. So let me ask you a broader question. We've talked about, why real estate, why multifamily. We've talked about the challenges of raising capital in this environment and trying to coax investors to opt in in a time when it's tough. It's tough. But when you do have capital, and obviously y'all have some opportunities in front of you at Black Salmon, where is Black Salmon seeing opportunities with multifamily? Specific markets? Is it new construction versus acquisitions? Is it Class A or value add? Give us a little bit of a rundown of what Black Salmon likes for it right now.
Yeah, Black Salmon has a unique approach in where we want to be the entry point for the Class A, right? We want to be the best in class neighborhoods, location matters, where economic growth is happening, where mass transportation is near. And we want to be that entry point. So we're not going to be the most expensive of the Class A, but where we're providing those higher amenities, where we're providing that more inclusive community to the multifamily. We've been very successful with that. We're super bullish on Miami. We also are opportunities in St. Pete, Florida. Florida's in our backyard. I mean, that's where the firm is based. But additionally, something that sets us apart is the fact that we had land banked back in 2017. So we're bullish on development from the residential side. Obviously, you need to develop, the best in class Class A, because it makes sense from our land basis. The fact that we got land back in 2017, we have an undeniable land basis that doesn't exist in Miami today.
That's
so
a
we've
big
already
advantage.
We've already created value. So we have a pipeline. Luckily, our partners were very they had strong conviction of the Miami market that they had planned ahead. So from the residential multifamily housing space, we saw the growth happening within Miami. We decided to pick off pockets of neighborhoods near mass transportation, economic growth, and really decided to hold and wait until the opportune moment. And it's done well for us. So we're bullish on development from the multifamily sector. Just because honestly, it doesn't make sense to acquire today. The cap rates don't make sense. You're buying with negative leverage, and there's uncertainty about the exit. Back to earlier when you were saying, everybody wants their 20% plus IRR, right? Of course, they'd love 30, 40, whatever. Anybody can write that in their Excel financial model, right? Doesn't mean it's going to happen. You can play with an Excel financial model all you want.
Well, sure, yeah, and obviously having like you said, land acquired in 2017, that's a pretty good thing to have, considering land prices are often challenging to get deals to pencil out with today's rates and today's rents. So I'm sure that definitely helps.
I would also argue, Jay, it's also working with states that have incentive for development. So Florida has something unique that other states, I hope, could model, where they're actually incentivizing developers to develop because they've noticed that they have a shortage of housing. So it's something called Live Local in Florida. And essentially, It allows for the entitlement process to be strictly administrative. You have no bureaucracies hindering the process. So you're going to get approval for your multifamily development. You can increase density. So you can increase the number of units. And then on the back end, you get a tax abatement for, allowing to list a certain amount of units more affordable. We call it affordable, attainable luxury, right? So say, one bedroom in Miami is $2,800 a month. We can list it for $2,300 and get the abatement on the back end. So we're still getting $2,800 in rent. So it's also working with states that have incentivized developers. California is not necessarily incentivizing developers to develop, unfortunately.
Yeah, no, it is ironic. The states that build the most are also the ones that are incentivizing it in places like Texas and Florida and the Carolinas, et cetera. So I'm with you there. Well, Alicia, thank you so much for spending some time with us today, and thank you for your insights. I'm sure these comments are both resonating with your peers and who are raising capital, and also hopefully a little bit encouraging and giving them some tips on how to be successful in this environment. So thank you.
Thank you, Jay. It was great to talk today.
And that's a wrap on episode 36 of The Rent Roll. Big thanks to Alicia for being our guest. Thank you to Waymaker and JPI, our headline sponsors. Thank you also to Foxen and the Guarantors. And thank you to all of you for spending part of your day with us. Have a great week.